One of the biggest strengths that a trader can have is knowing when not to take a trade in the market. Everybody wants to jump into the market, take trades right when the market opens at 9:30 ringing bell, but true strength and opportunities come to those who wait, especially in trading. So today I'm going to do a trade breakdown for you guys, and I'm going to show you guys exactly what I look for and when I avoid taking certain trades, such as opening drives or opening range breaks. There's certain things that I look for in order to know, all right, now I'm going to take the trade versus today is the day for me to not take any trades. So on October 22nd, I took this SPX trade. I went in with roughly around $48,400 as my position size, and the net ROI on that trade was 73% return, which is roughly in $35,750. This trade was taken because we were breaking out of the inside day or previous day's high and low. And that is a very, very important key level, because when you are looking at an inside day, typically the market doesn't move that clean. Typically we have very choppy price action. Even if it moves up or down, it's usually a very slow grind up or a very slow grind down. So for this trade's purpose, I'm going to show you guys the full process of why I went short. Now, there are a few key mistakes that I made in this trade, which I'm going to mention as we go over the trade, but this trade was based on break of previous day's high and low. First of all, let's go and identify that on the longer time frame. So you guys can see here, right, this is when the trade was taken, and previous day's high was roughly around 67.53. The previous day's low was around 67.22. I use SPY a lot to make my decision of taking trades in SPX. So when you translate that into SPY, you guys can see right here, this is the high and this is the low of previous day, right? So we're looking at this candle because the trade was taken during this time. Now, when we go into a lower time frame, you guys can see that previous to yesterday, which was on Tuesday, market was not able to break out of 670, right? So that gave us a very strong upside level of 673 and a very strong support of 670. And prior to that also, you guys can see that 670 played a very strong role when we were initially breaking out. So coming back to this, you guys can see that as we're coming back into the 670 level, right, volume gets very, very aggressive right around here, and then we get that aggressive break. So when I'm taking trades on SPX, my main focus is on SPY because it gives us a lot of information such as volume, then time and sales, and level 2. SPX on the other side is not going to give us that much information. So you have to correlate the levels on SPX with SPY and pay attention to mainly what's happening on SPY to be able to understand and take the best type of execution on SPX. So going back to this, you guys can see that 670 was a very strong level, right? So let's talk about the mistake first so you guys can kind of see where I messed up. Now, I jumped into the trade when it was initially pushing down, right? So right now it looks like a green candle, but at that particular point, we opened up right here and this was actually moving lower. And at that time, because of this candle coming on the downside, it had strong volume and I didn't wait for a small pullback. I jumped in the moment price slowed down. I paid around $8.80 for this trade, and the premiums went down to $6 and I believe 30 cents or 40 cents, which is roughly 25 to 30% loss if I had closed it. But because we were still rejecting that previous level that got rejected earlier on, and there were a lot of sellers popping up on level 2 and time and sales, keeping the stock down, I decided, all right, I'm gonna hold. I'm gonna extend my stop loss just a little bit because my initial stop loss was around 671, right? So we closed right above it, and right away sellers came in and we got pushed right down. The mistake again I made was jumping in here and not waiting for the pullback. If I had waited for the pullback and the second candle started to push down, that re-entry here would have been much, much better, because I also had profits from Oklo, which was a trade I took at the open. I was up roughly around 60% on that trade. I decided to risk some of the profits and hold this on that pullback. Now, when we started to come back down, you see that volume is very aggressive on both of these candles. And when we finally break that 670 level, which was the level that we couldn't break the previous day, you could see how aggressive the volume spikes, right? The volume almost went 100% higher than the previous candle here. So this is your sign that, all right, now there's more interest on that break. We also closed below that candle. Now you can pretty much hold that trade. So translating that now into SPX, you guys can see where exactly I jumped in. Should have kind of waited for this pullback, but I didn't, and that kind of ended up costing me. But the scaling out The first scale out was right around when we broke below the 67.20. The strike that I did was 67.20. And if you guys haven't watched my previous video, I would highly recommend you go and watch that, because that will help you understand how you can hold your winning trades for a much longer time. I scaled out right around $12.50. Then the premiums ran up to $18. I scaled out a little bit more. And then on the third scale out was around $22.20. The next mistake I made was that I didn't pay attention to the price action as the move was pulling back into my stop loss, right? When we started to pull back, I was not paying attention to the volume. Volume had decreased, which shows that there is a lack of interest towards that upside move. So it still had a little bit of room to continue on the downside. Because I didn't pay attention to that, I ended up closing the remaining position the moment this got very close to my stop loss. Now, that mistake cost me almost leaving 20 to 30% profit more from what I already made on the table, simply because I was not paying attention to these key details. It was mainly because I was also in a trade in Oklo, and that Oklo trade had paid so well. I didn't want to risk giving that back. So I was like, you know what, let me just take this profit and jump out. So a lot of the times, right, your emotions are connected with other trades that you take that might have a very high return, and that will cause you to have bad judgment in your trades. Now, if you look here, right, it does continue back. We continue to take another downside move, and it holds around that 6,700. We bounce, and then it continues to the downside. Now, if I hadn't stopped out here, or if I hadn't closed the trade here, this trade from 73% overall net, way above 100%. But because of the mistake of me not paying attention to the price and volume, which is the key thing that I always pay attention to, it ended up costing me to close the trade early. Right now, I'm not complaining about the profit, but I am showing you guys the process of how sometimes it's very easy to overlook small details, which can cost you leaving a lot of profits on the table. So what I did end up doing then was I went after this again right here. I did make a little bit of profits on that. Not enough for me to do a trade recap, but enough profits for me to be able to walk away, right? But when I look back at this trade, this wouldn't have happened if I did pay attention to the volume. If I paid more attention, I would have probably been still in this trade as runners, and I would have been able to capture a much bigger move. So when you're doing your trade recaps, it shouldn't simply just be, all right, this is how much I made, etc., etc. Also look for key points of the mistakes that you make and how you could have made a little bit more profit. This is a pattern that you want to look at overall across a lot of your trades, not just a single trade. This mistake that I made on this trade was simply because of the profits I made on other trades, which ended up costing me to not pay attention to key things, which again, I pay attention to very often. These premiums were actually where I got out roughly, my highest exit was around 22 and change. They went closer to 35, 40 bucks towards the end of the day, right? Simply just holding your runners a little bit longer and being able to pay attention to price action can make night and day difference in your trading. Right now, the market is actually open, right? So before I let you guys go, I do want to show you guys one more thing, which is not really connected to this particular trade recap. It is connected to the fact that right now we are having an inside day, and which is why I'm making this video, because that's kind of making me not go into the market. This is going to be the high and low of the previous day, and whenever price stays within that, that is considered to be an inside day, right? So you guys can see right off the bat at the open, right? We're gonna go into the 5-minute time frame. The first 5 minute, we wicked out very aggressively, and now following that, we are starting to close on the higher end. So now here, a couple of things to keep in mind whenever we're in range bound. This is for people who trade SPY and SPX. You want to go with 1 day out expiration. Don't go with SPX 0DT, because usually when you have an aggressive sell-off like this, you have VIX, which is the fear indicator that causes the premiums to be very aggressive on both of the sides. So when VIX starts to recover or lose value, when SPY starts to go up, those premiums start to lose value. So when you do 0DT, those premiums are going to lose value much quicker. You want to go with 1 day out expiration. This is just a tip I wanted to leave you guys with before ending this video, because market's open right now and I decided not to take an opening drive or any trades at the open, and I wanted to give you guys exactly why. It was because of inside day, and I wanted the first 15-30 minutes price action to form to get a better understanding of how the market is gonna be for the rest of the day, right? Because the first 15 to 30 minutes usually gives us an indication of if the market's gonna be clean or not. If you guys look at a few days ago, you have opening that were going on the upside, downside, a lot of wicks. So this kind of showed us that market is very choppy. This is a sign for you to size down. Versus the trade that I took yesterday, you guys can see right here that going into that 670, we had much larger volume as we broke into that level. Versus the other days, volume is all over the place. You have more wicks versus body of the candles. If this video helped you guys, leave a comment below what I should cover next, because majority of the videos I'm making are based on the feedback I'm getting. I want to make sure that the content that I'm pushing out is actually helping you guys rather than me just pushing content just to push content, right? So leave a comment below other topics you guys would like me to cover, and I'll see you guys in the next video.